Hey, I'm Alex, and we're back. This is Chapter 3 of 201. We're on the adjusting process. So, let me give the introduction. Do you subscribe to an internet-based music service such as Rhapsody? Rhapsody began by providing digital music to its subscribers through internet audio streaming. You can subscribe to Rhapsody Premiere for $10 a month, per month, and listen to new music by New Boys, Coldplay, Flo Rida, or Carrie Underwood, the goods. Rhapsody, which is partially owned by Real Networks, has also expanded its services to include games and video content. When should a company such as Real Networks record revenue from its subscriptions? Subscription revenue is recorded when it is earned. Subscriptions revenue is earned when the service has been delivered to the customer. However, in many cases, cash is received before the service is delivered. For example, the subscription to Rhapsody Premiere is paid at the beginning of the month. In this case, the cash received represents unearned revenue. As time passes, the services are delivered, the unearned revenue becomes earned and thus becomes revenue. As a result, companies like Real Networks must update their accounting records for items such as unearned subscriptions before preparing their financial statements. And for example, Real Networks reported its financial statements that had unearned deferred revenue of approximately $33 million as of December 31st, 2009. It's a pretty penny. This chapter describes and illustrates the process by which companies update their accounting records before preparing financial statements. This discussion includes the adjustments for unearned revenues made at the end of the accounting period. Okay, the nature of the adjusting process. When preparing financial statements, the economic life of the business is divided into time periods. This accounting period concept requires that revenues and expenses be reported in the proper period. To determine the proper period, accountants are generally use the generally accepted accounting principles, GAAP, which requires the accrual basis of accounting. So basically, when a revenue is earned for a month, you keep it in that month. When an expense is incurred for the month, you keep it in that month. You don't mix this month's expenses with next month's, or next month's with this month's, and you don't claim revenue from next month's to this month's, or you don't take revenue from a past period and try to claim it now. It has to be in the right time, critical. And this is all this accounting. The accounting concept supporting the reporting of revenues in the right period is a revenue recognition concept. So under the accrual basis, you want to make sure that expenses match the revenues. So the accounting concept supporting reporting revenues and related expenses in the same period is called the matching concept. So you want to match revenues and expenses in the same period, or matching principle. By matching revenues and expenses, net income or loss for the period is properly reported on the income statement. Although GAAP requires the accrual basis of accounting, some businesses still use the cash basis. Under the cash basis of accounting, revenues and expenses are reported on the income statement in the period in which cash is received or paid. So the only people that are going to use cash basis are small service businesses that may use cash basis because they have few receivables and payables. If you can have very few of those, you can do cash. For example, attorneys, physicians, and real estate agents often use the cash basis because they're normally just working with cash. But the normal method is accrual basis of accounting, which is what I use too for my books. Most larger businesses always use accrual because cash is not going to provide accurate, and accrual is accurate. That's what I like about accrual. Okay, so the adjusting process is when at the end of the period, like the 31st of a month, end of the month, you're going to make sure all your accounts are up to date. So not every account is going to be up to date based on just normal transactions for the month. Some accounts require updating for certain reasons, and this is where the adjusting comes in. Some expenses are not recorded daily. For example, the daily use of supplies would require many entries with small amounts, because each day you might use a little bit more supplies. So it's better just to wait to the end of the month, compare your first month, your beginning of the month supplies with the end, and the difference is what you used up. So you'll expense it. That's what I always do at the end of the month, is make sure my supplies match what's on hand. So, and you don't need to always update accounts day to day. That's trivial. Stay away from trivial. Sometimes people in accounting, they don't like accounting because they think, oh, I got to worry about everything every day, every moment. No. You have procedures that you'll follow at certain times. End of the month is just the accrual, is the adjusting day. Some revenues and expenses are incurred as time passes rather than as separate transactions. For example, rent received in advance, unearned rent, expires and becomes revenue with the passage of time. Likewise, prepaid insurance expires and becomes an expense with the passage of time. You can see the different sides. Some revenues and expenses may be unrecorded. You haven't even put them in the books. For example, a company may have provided services to customers that it has not billed or recorded at the end of the period. Maybe you have maybe you have revenue that you've earned, but you haven't recorded. I shouldn't have ate that protein bar so fast. So likewise, a company that may not pay its employees until the end of the accounting period, even though the employees have earned their wages in the current period. So they've earned them, but you're not going to record it to the end of the period. The analysis and updating of accounts at the end of the period before the financial statements are prepared is called the adjusting process. The journal entries that bring up to date the accounts at the end of the period are called adjusting entries. So there's the four basic types of adjusting accounts and adjusting entries are prepaid expenses, unearned revenues, accrued revenues, accrued expenses, the four basic. So prepaid expenses are advance payment of future expenses and are recorded as assets when cash is paid. Prepaid expenses become expenses over time or during normal operations. So let's say on the first, Net Solutions paid $2,400 as a premium on a one-year insurance policy. So at the end of December 31st, they're going to take $200. Okay, the beginning of the entry, you're going to debit prepaid insurance $2,400. You're going to credit cash $2,400 on the December 1st. At December 31st, you're going to swap it for $200. You're going to debit insurance expense for $200, credit prepaid insurance for $200 to show you're moving it from an asset to an expense. You've used up that insurance. Pretty handy. Unearned revenues are the advance receipt of future revenues and are recorded as liabilities when cash is received. So unearned revenues become earned revenues over time or during normal operations. So Net Solutions, let's say they received $360 from a local retail to rent land for 3 months. So I got the cash, debit cash, credit unearned revenue. It's a liability. I don't earn that. I actually still owe that money until I earn it. So after a month, at the end of December 31st, 120 of that 3 months, 1 month, I'm going to take and move it from unearned, debit unearned, credit rent revenue. So I actually get to earn that revenue because time has passed to where they owe me a month's worth of their rent. You see, yeah, keep your books organized. Okay, accrued revenues are unrecorded revenues that have been earned and for which cash has not yet been received. Fees for services that an attorney or a doctor has provided but not yet billed are accrued expenses. So, let's say Net Solutions signed an agreement with Danker Company under which Net Solutions will bill Danker Company on the 15th of each month for services rendered at the rate of $20 an hour. So, although the revenue let's say we made $500 for 25 hours for the month of December, $500, but it will not be billed until January. January 15th. But we've earned it on December 15th. So the cash, we're not going to get the cash till next month, but we've earned it for this month. So, of course, we're going to debit, we would debit a receivable, accounts receivable for 500, and we'd credit fees earned of 500. Because we've earned it, but we haven't made the cash. But the next month, we'll take it from, we'll credit accounts receivable, debit cash, and now we've turned our receivable back into cash. So that's an accrued revenue where you've earned the money, but you haven't gotten the money. You're just waiting on it. Okay, accrued expenses are unrecorded expenses that have been incurred and for which cash has not yet been paid. Wages owed to employees at the end of the period but not yet paid are an accrued expense. So let's say Net Solutions owes its employee wages of $250 for Monday and Tuesday, December 30th and 31st. So we're going to debit wages expense for $250, and we're going to credit wages payable for $250. We're not going to pay them this month, but we owed them this month. The expense has been incurred. The wages were worked in this month. So next month when we give them their paycheck, we'll debit wages payable, credit cash. So then we can pay them. You see how you're keeping the expense of the wage in the right month that they were doing the labor. So it's all about making sure that cutoff period is on par. Okay, the cash receipts for accrued revenues are normally received in the next accounting period. Accrued expenses are expenses that have been incurred but unrecorded. Prepaid expenses and unearned revenues are sometimes referred to as deferrals. This is because the recording of the related expense of revenue is deferred to a future period. Accrued revenues and accrued expenses are sometimes referred to as accruals. This is because the related revenue or expense should be recorded or accrued in the same period. So deferrals means you're deferring the expense or the revenue to a future period, and an accrual means you're recognizing the expense or revenue in this period now, regardless if you're going to pay it or not. You'll pay it later. So accruals is get cash, pay cash later. Deferrals are pay cash, get cash now. Remember that. Alright, so you're going to have an adjusted trial balance. After we talked about the trial balance, after you do your adjusted entries, then you'll do your adjusted trial balance, which is just like a trial balance, but now you've added in the slight differences of the adjusted entries. So if the cash account changed because of an adjusted entry, it'll be reflected in the adjusted trial balance. Once again, debits have to equal credits, so it's a good check figure. And those are the four big ones. There's also going to be depreciation. So depreciation expense, fixed assets or plant assets are physical resources that are owned and used by a business and are permanent or have a long life. Examples of fixed assets include land, buildings, and equipment. In a sense, fixed assets are a type of long-term prepaid expense. However, because of their unique nature and long life, they are discussed separately from other prepaid assets. They are different. So, fixed assets such as office equipment are used to generate revenue, much like supplies are used to generate revenue. Unlike supplies, however, there is no visible reduction in the quantity of equipment. Instead, as time passes, the equipment loses its ability to provide useful services. Excuse me. This decrease in usefulness is called depreciation. It's why you may have to sell your car after 5 years and get a new one. It's used up its usefulness. It's done. It's over with. Move on. All fixed assets instead of land lose their usefulness and thus are said to depreciate. This periodic expense is called depreciation expense. The depreciation expense account is increased by a debit. And the opposite entry is going to be a accumulated depreciation, which is a credit. Accumulated depreciation is a account that's a contra account or contra fixed asset. This is because accumulated depreciation reduces the fixed asset value on the balance sheet. So it's going to lower your book value on the balance sheet. So your original equipment minus your depreciation gives you your book value. The fixed asset is a debit. So the accumulated depreciation is a credit, which will lower the value. Land never depreciates. So land will never depreciate. Land is land. Land's there to stay. But buildings, store equipment, office equipment, all depreciate. And they'll all have an accumulated depreciation. And basically depreciation, we'll get probably into different methods. We'll get into different methods later. But there's straight line, which you just take the useful years. So if you had assets worth 10,000 and it has a 5-year life, 10,000 divided by 5 would be 2,000 a year. You'll depreciate, and then you'll divide that 2,000 by 12 and get the per month depreciation, which will be used for your adjusting entry. So remember that. And yeah, so the adjusting entries are a big deal. And we just talked about the adjusting trial balance. All adjusting entries are posted to the adjusted trial balance. Verifies credits equal debits. And then for the final section, talk a little bit about financial analysis, vertical analysis. So vertical analysis is a term used to describe such comparisons. In vertical analysis of a balance sheet, each asset is stated as a percentage of total assets. Each liability, owner's equity item, is stated as a percentage of total liabilities, owner's equity. So you can take a 2011 balance sheet and compare it to a 2008 or 2012 and see the difference. So here we're using the income statement. So we have fees earned, 187,500, 100%. Wages expense, 60,000. That's 32% of our 187. So wages expense is 32% of our total is actually our total is 32% of our revenue. It's taken that. That's see how percents kind of help. It helps percents help visualize and help make it more practical. Our net income is 95,000. So our net income is 50.7% of our fees earned. So of the revenue we earned, only 50% we're taking home. We're actually going to make over expenses. But compare that to last year. Last year we had 150,000 in fees earned, 100%, and our wages was actually only 45,000, 30%. So we had a lower percent on wage. Our net income was 79,200, which is less. That was less than our income for this year, but it was 52.8%. Our percent was higher, so we actually kept more of our revenue for last year. So we lost our net income actually went down compared to our fees earned. See how it's good to do some analysis on using percents? A great section. So feel free to ask any comments on chapter 3. Once again, I'll probably do some examples later on, but I just wanted to get through the theory and the discussion, because sometimes it can be strange. If you have any comments, ask them. Maybe I can answer. So, yes, I'll see you guys tomorrow, where I want to do chapter 5. So, chapter 5 is something to look forward to. Oh, accounting systems. That's very lovely. Now we're getting into some of the meat and potatoes. So, all right. Thank you, and have a good day.